On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So, before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Just a quick take today on the Reserve Bank meeting, which we obviously had earlier this afternoon, about 2 o'clock. The Reserve Bank coming out with its latest OCR decision and also releasing a fresh monetary policy statement, which made this meeting more important than some of the other meetings because you do get a new set of economic and financial projections that gives you a lot more information about where the Reserve Bank sees the economy, inflation, interest rates, and all of those other things going over the future. So, long story short, they left the OCR unchanged. That was completely expected. So, unchanged at 5.5%. They also left it unchanged at the previous meeting in July. So, that's two now. We've seen no change. Before that, of course, before the July meeting, we had 12 consecutive meetings where they increased the OCR. It was 0.25 a little more than 2 years ago. They started increasing it in October 2021. And over the course of 12 meetings, they took it from 0.25 right up to 5.5. And now we've had two meetings where the Reserve Bank was on hold. So while it's well above those levels that we saw through the period of the pandemic, and it's still the highest that we've seen since 2008. It's certainly not anywhere near where it got to in the lead up to the GFC. Many people will remember that it peaked at 8.25% heading into the GFC. So we're still not anywhere near those levels, but there is a good chance that we are at the peak for this cycle. Not guaranteed. Anything could happen, but there is a good chance that we are at the top. When we look at the forecasts in the associated monetary policy statement, they do reflect a more resilient economy. They show the path for economic growth looks a little bit better. They reflect slightly more persistent inflation, not dramatically so. When you sort of look at where inflation's at now, it's about 6% per annum at the headline level. Back in May, when we last got a monetary policy statement, they saw their headline inflation rate falling to 4.9% by the end of this year. And now in the new forecasts, they see it only falling to 5.2. So just remaining a little bit higher through the balance of this year and through the bulk of next year. They still have inflation coming back into that 1 to 3% band, which they're, of course, targeting. They've got that in their numbers for the third quarter of next year, and that's unchanged. But between now and then, it is expected to remain a little bit more persistent. Also, the labour market. We know the labour market is easing a little bit. It's a little bit easier for businesses to find workers. We've had high migration, but it still is quite tight. And the forecasts that we have seen released today do reflect that. So the unemployment rate is expected to keep rising, but not rise as much over the next 6, 9, 12 months as might have been previously expected. So some good and bad news in there. I guess the part of the forecast pack that catches everyone's attention, that all the economists and so forth look at, probably one of the first things they look at is the OCR track, and they did increase that. So back in May, the forecast pack pointed to 5.5%, which is where we're at today, being the top. That was the peak, and then it started coming down from the third quarter of next year as inflation came down. And that is one thing that's changed. So instead of the peak being at 5.5, the peak is now 5.59 in the middle of next year, and then it starts coming down. So You're obviously unlikely to have an OCR of 5.59. The Reserve Bank moves in 0.25% increments, but I think what that does reflect is just some increased risk that they might have to do a little bit more. You've got a stronger economy that's more resilient. You've got inflation that's tracking a little bit higher, and we're not out of the woods yet, basically. So there is a chance that they will potentially have to do a little bit more, but I don't think we should read a whole lot into that. That will be something that gets some headlines, that they have pushed up that OCR track, and many people will interpret that as the Reserve Bank giving a bit of a warning that the OCR could still go higher from here, and that, I guess, that is the case. But when they held the press conference, they released all this data at 2 o'clock. Then they hold a press conference at 3 o'clock with Governor Adrian Orr and a few of his colleagues. They did sort of put that in perspective. And at the press conference, they talked about a lot of things. They talked about the current level of the OCR being enough to constrain spending to get inflation under control, in their view. The neutral rate, which is sort of that steady state rate, it's kind of your break even level, for lack of a better term. In the short term, that's at about 3.9. So, if you're at 3.9, it's neither sort of slowing things down or speeding things up. And the RBNZ took the OCR beyond that level late last year. We're now obviously at 5.5. So if your neutral rate is in the high threes and you're at 5.5, you are actually slowing things down. And they're very conscious of that. So they believe they're where they need to be to get inflation under control. What they did say is that it needs to stay there for the foreseeable future. Economic activity slowing, especially some of those interest rate sensitive areas. Labour shortages are easing. That's on the back of less demand and higher inflation. Headline inflation and inflation expectations have declined. They were pleased about that, but they talked about the core inflation still being too high. And that's something that we've seen everywhere around the world. We saw that in the US with that inflation report last week, I think it was, too. Lower global growth, putting pressure on commodity prices and export revenues. We've obviously seen that with the dairy sector and the slowdown in China. Some new numbers out this morning, in fact, where we had the global dairy trade auction fell by a degree, 7.3% it was at the headline level. Haven't seen that for a good 7 or 8 years. So that trend has continued, and the payout could easily be in the sixes, in the $6 sort of range, if those trends do continue. But all in all, the Reserve Bank is confident that it'll get inflation back to its target range. On that increased track, that will get some attention. They did point out that that wasn't forward guidance, that it's not a strong signal as the likely next move. They said it was really just a result of the modelling. It's a result of a higher starting point. You've got more stable house prices now. You've got slightly higher inflation across the board, and that forward track will change through time. So they seemed pretty relaxed about that. They sort of pushed back on the notion that it was a change of view. They said, look, it's not really out of line with market pricing the way we see it. We're in watch, worry, and wait mode. And they think that they are doing enough, which I think is probably fair, especially when you consider the lags of monetary policy. Obviously, the moves we've seen over the last 18 months have been significant, the last 2 years really, and those haven't fully flowed through to borrowers' costs. If most New Zealanders that have a mortgage fix their mortgage, I think sort of as much as sort of 80 or 90% of us fix our mortgages, and that means that we don't feel the effects right away. So there are still a lot of people who haven't actually moved onto those higher mortgage rates. So there's still a bit of impact that the Reserve Bank is yet to get from the OCR, and that's going to come even though they've been on hold for the last couple of meetings. So I think they see themselves as being on the right track. There was a couple of questions on the recent dairy price weakness. This is interesting because it's obviously very new news, and things seem to have taken a turn for the worst over the last couple of weeks. Governor Orr did say that those moves were largely as expected by the bank. He would say that, and I think that's probably fair. But I'm not sure. I'm not sure they would have been expecting things to really decline quite as much as they have. I'm not sure they would have seen such a weak outcome. So we'll just have to watch and see how that plays out. He did acknowledge the difficulty that would cause across the agricultural sector. And he talked about a few of the other sectors as well that are under pressure: commercial real estate, construction. Those parts of the economy are very interest rate sensitive. So obviously they're going to remain under pressure over the short term. But look, for the most part, it was a steady as she goes sort of statement and set of numbers, largely in line with expectations, a few swings and roundabouts here and there. Jury's still out whether we are at the top in terms of the OCR. I still personally think we are. I think they've probably done enough, and I think when you look at some of the economic developments of late, the dairy sector and so forth, I think they will slow the economy in lots of parts of New Zealand. And I think when you look ahead over the next 6 months and you get another group of people sort of rolling off into those current mortgage rates, then they will you will see a significant effect. So I'm not convinced they need to do more, but you can never rule it out, and that's why a couple of the banks are still forecasting another OCR hike. So for investors, it's probably more of the same. No real change. We're either at the top or we're close to the top. So I think for those looking at bond markets, there are opportunities there that are worth talking to your advisor about. For share market investors, uh, what the Reserve Bank does is probably less important than what happens on the earnings front with corporate earnings, and that's much more of a function of how the economy develops. And you've definitely got some headwinds on that front in some sectors, and we saw that come through loud and clear in the Fletcher Building result this morning. Plus, there's the election. Plus, there's all of those global issues that we're keeping a close eye on, such as the Chinese economy and what you see from other parts of the world. So, no real change to my thinking from today's monetary policy statement or OCR decision. But what I would suggest, if people are interested, is take a look on the Reserve Bank website. They're very, very transparent and very generous with the data that they release and offer to people. So there is a world of information that they release on their website. You can also go on their YouTube channel and see the press conference that Governor Orr does with the journalists, and some of the journalists ask very sensible, probing questions. So you learn a lot from that. But hopefully, I've summarised some of those key issues. So that's all for now. We'll talk again soon.
For more insights, visit craigsip.com.